2 days away from the Fed meeting. That's your main event on Wednesday and a ton in between. It's a big week ahead. Futures up 1/3% on the S&P 500. On a Russell, up about 0.4%. On the Nasdaq, negative about 1/4%. From New York City this Monday morning, there's your opening. But I'll switch on the board and get to the bond market. Last Monday, on a 2-year yield, 142. On a 10-year yield at the open, 168. You can add 40 basis points to twos, add it to tens as well, and some. Just short of 2.1% on a 10-year right now, up 10 basis points on the day, and up more than 40 basis points from where we were this time a week ago. It's a big turnaround in this bond market over the last week. In the FX market, euro-dollar positive 0.4%, 109.54, and crude on the back foot. A break of 104, almost a break of 103 this morning. 103.94 now, down by almost 5%. About 30 seconds into this one, we advanced by 0.2%. Given the move you see in the bond market, financials up by more than 1%. Energy down 0.6%, in line with what we're seeing in the commodity market this morning. Let's get you some movers at the open, shall we? Here's Abby.
John, let's dig deeper into those mixed moves because, of course, the S&P 500 up slightly, the Nasdaq down, dragging on both of these indexes, and the Dow, for that matter. Apple down about 2%, down 1.8%, 1.9%. This, of course, is Foxconn halts iPhone production in Shenzhen after the lockdowns. We also have the energy sector lower, as you were just mentioning, in sympathy with oil. Occidental Petroleum, one of the bigger laggards, down 3.9%. On the other hand, you were talking about those surging yields. Bank of America and JP Morgan, both beneficiaries of that. You can see big gains for the banks on the morning, John.
Abby, thank you. An update from a particular bank called Citi. Citi expanding its retreat from Russia, saying in a quote, in a statement just moments ago, we are moving with urgency to complete our assessment of our operations in Russia. We have also decided to stop soliciting any new businesses or clients and continue to reduce our remaining operations and exposure. Bloomberg's Sonali Basak on top of this one. Sonali, good morning.
Good morning, John. As you know, Citigroup really does have the largest of the exposures of the big U.S. banks when it comes to Russia. It has almost $10 billion worth of loans, assets, and other exposures with Russian companies as well as the Bank of Russia. That's the operative word there. Remember, Citigroup is a placement agent on some of the debt that is coming due of Russian sovereign debt. So that is going to be closely watched by the market here. But remember also, Citigroup also has 3,000 some employees when it comes to Russia. That is leaps and bounds bigger than the other banks. Goldman Sachs has about 80, JP Morgan has a couple of hundred, Morgan Stanley has about 20. So moving all of those employees is going to be a difficult task as well. So what do we make of it here? It will take some time. The banks are still required to make markets when it comes to Russian debt and corporate debt that is not sanctioned, but there is a question of whether they are speculating. Goldman Sachs has already come out and said that it would not be, but there is a limitation here to which banks will engage.
Sonali, this is about going beyond the consumer business in the country, and to your point on time, they say that in the first paragraph, the decision will take time to execute. You've touched on it. I want to build it out a little bit more. I actually want to sit on the consumer business in the country. There was hope they could sell it. How do you find a dance partner when most of the banks are sanctioned in Russia?
Well, that's the key issue. They wanted to exit this operation beginning of April of last year. This was part of the grand exit of many of the operations that they were planning on getting out of. But to your point, the banks that would buy them, some of them are sanctioned. So it is very difficult to find a partner there to exit the operation too. There's also another issue here. At what price? How do you exit an operation, let alone any bond, if you're an investor on Wall Street right now, when it is so hard to find a buyer at the other end? Do you then take the markdown, or how else will you wait it out?
Sonali, thank you. Sonali Basak, this is happening with everyone trying to do the same thing all at the same time. We'll catch up with Sonali through the week, particularly on those two interest payments on those dollar bonds that we get from Russia, or we're meant to get from Russia later in the week. Damien Sasser later this hour as well. Elsewhere, recession risk is the big story for a lot of people. This is what the team at Ned Davis Research had to say. The biggest factors, the three biggest factors that tend to drive the U.S. economy into a recession: inverted yield curve, some kind of commodity price shock, or Fed tightening. Right now, there appears to be potential for all three to happen at the same time. Taylor's back with us. Hey, Taylor.
John, you're right. All three at the same time. Let's start with the first one that you mentioned, right? The yield curve. Now, I want to be careful. It's a little bit more of an art than a science, but you are getting some big flattening of that yield curve, particularly particularly on the 530s, which this morning was just 3 basis points away. But most analysts say that even if you get a yield curve inversion, you still have about 12 to 18 months before a recession. This time around as well, even though QE officially ended last Friday, there are some technical factors anchoring the long end of that curve. But still, it is an indicator, right, and something that analysts are really watching. If you change up the board, it also, as we mentioned, higher inflation and one of those signals, right? And how does a consumer in a consumer-driven economy handle and stomach rising prices that, as we know, has been going on for at least a year or two, given some of the COVID supply disruptions? If you change up the board, that is also now expanded, given Russia's war on Ukraine, to not only oil, John, but you think about corn, nickel, wheat, food inflation. I think one of your guests earlier said we're always going to eat, but how do you think about substitutes to cheaper prices, and really how you think about the impacts of this on the consumer?
All done, Taylor. Do we see you again? We see you tomorrow?
Yeah, maybe I'll come back.
That would be nice. That would be nice. Taylor Riggs on the close a little bit later with Romaine Bostick and Caroline Hyde. I want to stay on top of this story, and I want to bring in you, Richard Bernstein, and get your thoughts. How this equity market withstands those 3 shocks that Taylor just went through. The idea that we get a Fed that's tightening, a commodity price shock, and on top of all of that, we're staring down the barrel of potentially yield curve inversion before year end. Is that the kind of market where you get stocks higher through 12 months?
Not the perfect combination that you'd want to see, Jonathan. Look, I think simplified even more. As we look at 2022 into 2023, we know that profits growth is going to slow. Right, we've seen tremendous profits growth. We know we're going to see that slow. At the same time, we're going to see the Fed raising rates to some extent, probably both short-term and long-term rates, as they extricate themselves from the long end of the curve. So the combination of slowing earnings growth and rising interest rates is probably not a good combination. I think if you had to choose what combination you'd want of up and down rates and accelerating or decelerating earnings, you wouldn't choose this combination. So I think it's going to present some headwinds for the market. One final thought on this, though. I think the way to think about this is think of the market as a seesaw. There are going to be beneficiaries, and those beneficiaries may do very well. The ones that are hurt are going to do probably pretty poorly. The fulcrum of that seesaw could be the market. So the market may go up or down, but it's going to hide a lot of the excitement, if you will, at either end of that seesaw.
David Kostin at Goldman makes this simple, Seema. He says lower earnings, lower price. They cut their price target to 4,700 from 4,900. That's still 10% upside from where we were at the close on Friday. They go on to say a surge in commodity prices and a weaker outlook for US and global economic growth lead us to lower our EPS estimates. Seema, have we done that sufficiently now, given what we've done, the amount of work we've done in this market over the last several weeks?
I don't know if it's gone far enough. Everyone listening will know it's so difficult to make any kind of forecast in this environment. And I think we're all trying to do as much as look at the overall scenarios and what could and couldn't happen. I do think that in this scenario, clearly, this is more challenging. It's going to be harder to make gains for risk assets, particularly equities at this time. I think for investors, it becomes more and more important to look globally. Where can you hide out? Where is the relative value trade going? And for us, yes, US is going to find tough times ahead, but is it going to be as tough as Europe? Probably not. So that's one of the reasons where we look at the US, we think, okay, you've got to make a trade. Let's focus on the US over Europe.
Is that your preference too, Stuart? The US over the rest of the world?
I think it would have to be now, Jonathan. I mean, we took down, our global GDP numbers by 100 basis points last night, but, the U.S. economic numbers were relatively well insulated from that. So it does seem like on a relative basis, our economy and potentially our consumer are a little bit, better positioned to deal with just because, the hit to consumer confidence and consumer spending gets largely balanced by investments in the energy sector. So, I do think that does make a lot of sense. It seems what I think we are kind of early in the process of revising down earnings. The question is, has the market kind of pre-traded that from a price perspective? And I guess we'll see how that evolves kind of over the next couple of weeks and months.
Stuart, any suggestion that has happened? What would you look for? Chris Harvey of Wells Fargo would use the technical term cathartic puke when we've had that big downdraft and we just get it all over with all at once. Stuart, what do you look for?
We're looking for a number of things, Jonathan. In the vol market in particular, it would be, a steep inversion of the term structure. We're looking at intraday volatility as a potential sort of capitulation signal. Globally, U.S. equity volatility actually is reasonably low relative to other assets and other markets. And I think in a true capitulation market, you probably see a solid amount of demand for hedging in U.S. assets that should push the VIX up on a relative basis. And, the last one we hear, and I think it's actually a rather unstable one, but is a quote-unquote high-volume sell-off. And these sort of high-volume sell-offs tend to happen about half the time around market bottoms. So I don't think any of these is the, canary in the coal mine. I think you need a lot of canaries. So in this case, we've got a lot of birds flying around, and we're just trying to figure out which one's going to give us the best signal today.
Hey, it's a tough time. Stuart Kaiser, thank you, sir. Alongside Richard Bernstein and Seema Shah, your equity market. About 10 minutes into this, we are negative 0.1% on the S&P. On the NASDAQ, we are negative 0.6%. If you're looking at the NASDAQ Golden Dragon China Index, that drop extends to 13%. We're going to pick up on that price action in just a moment. Just hearing from the EU to decide on the next Russia sanctions later today. So look out for that a little bit later today. Coming up, China-Russia relations taking center stage.
We saw Russia and China come closer together, and at the same time we've seen China pretty uncomfortable with an invasion of a sovereign country.
And China has problems at home, another big headwind for growth in the world's second largest economy. That's next.
We saw Russia and China come closer together, and at the same time, we've seen China pretty uncomfortable with an invasion of a sovereign country. I think the PRC is watching very closely, has to make some tough decisions.
It's looking awkward for China, that's for sure. Just getting a headline on Ukraine's president to address Congress virtually on March 16th, and that's 2 days from now. President Zelensky to address Congress virtually on March 16th. Just getting that headline. I mentioned that China has problems at home. They do, sticking to its COVID-0 policy, placing more than 20 million residents of Jilin province into lockdown after a surge in virus cases. Bloomberg's Abigail Dillittle has more. Hey, Abby.
Hey, John. Well, this is really pretty incredible, as it feels as though the virus is winding down to some extent here in the U.S. It is surging elsewhere, including Germany, but China. And because of that zero tolerance policy, they are locking people down. In the north, as you mentioned, many people. And then the southern cities, notably of Shenzhen, more than 17 million people there. This is in response to more than 1,400 cases. So it does not feel like a ton of cases. But again, because they do have the zero tolerance policy, plus it represents a fourfold jump in a week. Now, of course, we are hearing big headlines relative to business and the economy about big companies shutting down plants right now. This includes Huawei, Tencent, BYD, Foxconn. Foxconn getting a lot of attention because one of the biggest drags on the averages here in the U.S. right now. Apple down because Foxconn has halted production on that iPhone. And this brings into question, you were just mentioning so many headwinds here for investors, for some of the big tech names. They are at multi-trillion-dollar valuations. Apple, Microsoft, Alphabet, and Amazon. You, of course, have the Hong Kong tech sector under question and under pressure, as you were mentioning, that NASDAQ Golden Dragon Index down for a third day in a row, the most since going back to 2001. And here we have yet another pressure for these big tech stocks, Sean.
The Chinese stocks absolutely hammered. Abby, thank you. Apple, as Abby points out, down by 1.4%. Wanted to make some time this morning for an important conversation with Damien Sassower of Bloomberg Intelligence. Damien, on China, and then we can move across to Russia. Can we talk about the two at the same time as well?
Yeah.
Just how this relationship seems to be adding just a little extra poison to the market story in China.
Absolutely. I mean, look, we know, and we've said this since the very beginning of time, Jonathan, I mean, China can end this conflict tomorrow if it so chose to block Russia off. It has yet to take a side. They will need to take a side before all is said and done. And so we're getting a bit of a sense here of the market jitter surrounding that. And certainly, look, the COVID-0 policy and what's going on in Shenzhen, forget about Shenzhen, the Greater Bay Area is 86 million people, 4.2 trillion in economic output per year. That's bigger than Germany, almost as big as Japan. So, just the fact that Shenzhen's locked down and the sort of ancillary impact to the region is extreme. And so Chinese tech, especially Chinese tech, is really taking it on the chin. We saw Meituan, we saw Baba, Tencent, all down double digits overnight. And I think the greater, the Golden Dragon Index, which is the Chinese listed ADRs, just lost 10% for 2 days in a row. That's never happened before in 22 years, and it's just been pain and it's bloodletting and blood on the streets, Jonathan.
Well, Damien, let's talk about how that might impact the commodity market then, because we're looking at huge parts of China locking down. On the same day, I've got a commodity screen that's deep in the red.
Yeah.
Accepted, we've had a massive move in the other direction very recently, but Brent and WTI down 6 percentage points. What kind of growth hit are we looking for here, and what kind of an impact would it have on the commodity market the other way?
Well, I think, we have to differentiate between what a VAR shock is, a value at risk shock, and what the medium-term economic impact from rising commodity prices and the Putin's war in Ukraine is going to have on the global economy writ large, Jonathan. So you've just hinted at it, right? The market is not yet positioned for full max pain. It's not positioned for the fact that these rising commodity prices are going to feed into global growth, and they're really going to kill it over the better part of this year. And I believe that the market's not prepared for that. I think what's interesting about it is you're absolutely right. You're seeing European equities. You're seeing Euro Yen all rally. We're seeing crude oil and gold sell off. But really, does anyone believe it? I mean, maybe we're in the midst of a bit of a beta regime here, Jonathan, in the sense that, maybe dollar yen isn't the safe haven we once thought it was. Maybe the Fed is really that far behind the curve, unfortunately.
Wow. And the Fed's got a lot more work to do. And it starts this Wednesday. Damien, here's the line I want to start with on Russia's debt with you, the finance minister. Quote, the debts we need to pay to the countries that have been unfriendly to the Russian Federation and have limited our use of foreign currency reserves, goes on to say, we will pay off our debt to those countries in the ruble equivalent. Now, as you know, because you've told me, so I'll repeat it for our audience, on Wednesday, 2 interest payments on dollar bonds of Russian debt, sovereign debt. If they did that in rubles, is that a default?
Yes. I mean, obviously it won't technically be default until the grace period is over, which is probably something on the order of 30 days. But absolutely, those two bonds do not have the fallback optionality. There are 6 dollar-denominated Russian bonds where they have this covenant in there, which allows them to pay in other currencies such as the euro and the yen and the ruble. So, what's interesting is on the 11th of last week, the Credit Derivatives Determination Committee basically ruled that those 6 bonds, if there is indeed a default on Russian dollar bonds, those 6 bonds where they can pay in rubles will not be a part of that mix. So that's a pretty big deal. So anybody who's holding those bonds and thought that their credit default protection was going to cover them for the losses, forget about it. That's not going to be the case anymore.
So Damien, go through the sequencing for me from Wednesday when it's due. 30-day grace period. What happens in between?
So in between, we're going to hear a lot of rumors that perhaps they are going to make payment. Perhaps monies have hit their accounts at whatever the custodial banks are, Citigroup, et cetera. We're going to be watching very similar to the way we watched when Evergrande was threatening default back a few months ago in China. And it's going to be sporadic information. Some people are getting paid. Some people are claiming payment. Some people aren't. But at the end of the day, I see no reason why anybody in the West wants that money because of all the risks associated to it. And quite frankly, Russia doesn't want to pay it anyway. They've made that abundantly clear. So, I think I have to agree with Fitch in this case that default is inevitable.
Will the pipes clear it? Can you make this really simple for me? If you're the sovereign and you try and pay foreign investors, you're Russia, you're trying to pay a foreign investor, does it go through the pipe?
So I don't think so. You see, what's interesting, I've talked to a lot of investors, those who will actually pick up my call amidst the crisis, and anybody who is trading in RFLBs, that's Russian local denominated debt, Jonathan, they were able to move stuff no problem up until the 25th of February. At that point in time, all bets are off. In fact, anybody who was trading in RFLBs had to attach a printout of the QR screen on Bloomberg to show the actual trade date, to timestamp it, to show that they could actually move their money out on the custodial side out of Russia into dollars. After the 25th, forget about it. Nobody has tested that I know of, and all bets are off. So yeah, I mean, it's the plumbing is certainly.
So this gets complex, Damon. If we can finish on this, if the sovereign or the whoever it is, the corporate tries to pay, but it doesn't go through the pipes, it doesn't clear, is that a default or not?
That is a question.
If the money never reaches the investor, but you've tried to pay the investor.
Yeah, no, I mean, if they're making every effort, I guess, if, whoever the Russian issuer is, let's just say it was a Russian corporate, right, who has nothing to do with all this, and they actually want to pay their dollar investors, but they need to take dollars that are sitting onshore in Russia, and they have to move it into a vehicle that can actually pay it offshore, and they can't. Does that constitute a default? I do not have an answer for you at this stage.
What a tough time. We're going to go through all of this through this week, at least we'll try, and we'll start on Wednesday again. Damien, great to catch up, buddy, as always. Damien Sasser. No Tom Brady action either. Do you want to do 30 seconds on that? We've got time.
Yeah, we do have a
Damien,
little bit
did
of time,
you think that was Agent Cristiano that got that done?
I have to say to all our audience out there, I mean, this is Jonathan's real estate, but my goodness, he called it last night. We were talking about, Giselle, something must have gone right on the home front. Jonathan sends me this video of Cristiano Ronaldo talking to Tom Brady on the sidelines, and my goodness, it's pretty scathing. I mean, Tom knew a few hours before he announced that he was moving. And by the way, they tried to sell a football, Tom's last touchdown football, $518,000 the day before. Oh my goodness, I hope...
You've got to give him the money back.
Right, you got to do it. I agree.
Damien Sasser, thank you. Let's get a sector price action. Here's Abby.
Hey, John. Well, we do have the S&P 500 up about 0.3%, making it interesting. Most S&P 500 sectors are higher, but as you can imagine, not by much. The top sector, though, financials up 1.8%. On the other hand, you have tech down slightly, so that's the biggest weighting to the index, and you have energy down 3.6% in sympathy with oil down about 6%. Now, on the year, though, it's the reverse. Energy is the only sector higher, one sector lower, despite the fact that we have yields absolutely surging. The bank index down about 5%. But again, today, financials, the top sector, up 1.7% as yields surge ahead of that Fed meeting, the decision on Wednesday, John.
Abby, thank you. Looking forward to that Fed meeting in a couple of days' time. On Wednesday, the same day, March 16th, 9 a.m. Eastern Time. That's when we will get that virtual address to the U.S. Congress delivered by President Zelensky of Ukraine. Wednesday, 9 a.m. Eastern Time. Your trading diary. Up next. 25 minutes into the session, equities up just about 1/3 on the S&P. Energy lagging this morning. Financials top of the pile. Crude lower, yields higher. Speaking to that theme, that's your price action. Here's the trading diary. What a week we've got coming up for you. Secretary Blinken speaking at the top of the hour as we await details from US-China talks. US PPI on Tuesday. Russia's coupon payments on $2 bonds coming due on Wednesday. Plus President Zelensky also addressing Congress on the same day. On the very same day, a big week starts for central banks. The Fed kicking it off with decision day and Chairman Powell's news conference. The Bank of England out with its own rate decision on Thursday. Then we'll hear from the ECB's Lagarde. And finally, we'll round out the week with another decision. Two of them from the Bank of Russia and the Bank of Japan. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Monday, March 14th. Here are the top stories we are following for you at this hour. The talks begin. Top officials from the United States and China have started the first high-level in-person discussions since the war began in Ukraine. The conversation comes as the Biden administration seeks Beijing's help with Russian President Vladimir Putin. And another lockdown. China imposes restrictions on its tech hub of Shenzhen, potentially inflicting the biggest coronavirus-related blow to growth since a nationwide lockdown in 2020 as the
the rest of the world braces for further supply shocks. What does that mean for the markets? Well, climbing yields. Bond sell-off sending yields to the highest since July 2019 as the isolation of Russia upends commodity flows, and investors anticipate the start of a rate hike cycle. From New York, I'm Kriti Gupta with Guy Johnson in London. Alex Steele is off. Welcome to Bloomberg Markets. Guys, so much to digest here, whether it's China, whether it's Russia, commodity flows, and of course, the spotlight back on the Fed this week.
Absolutely, and everything feels inflationary, doesn't it? That story out of China feels inflationary. What is happening with the commodity story, I appreciate that we're seeing lower oil prices today, but generally that story feels inflationary too. The question that I'm trying to answer here, and it kind of goes to our question of the day, what is the bond market really pricing right now, is are we in a position where the Fed is going to be aggressive but not that aggressive because it's worried about causing an inflation, or is it going to have to cause an inflation because it's worried about a recession? Or is it going to have to cause a recession in order basically to deal with inflation? I think that's what everybody's trying to get their arms around right now, and I'm getting really conflicting signals from various market participants. So let's try and get an answer to that question. Romain Bostick, co-host of Bloomberg Markets The Close. Ira Jersey, chief US rate strategist for Bloomberg Intelligence, joining us now. Ira, what are we pricing in now?
Yeah, so we're pricing in for basically 8 full rate hikes over the next year and a half or so. And that means that the Federal Reserve is, the market thinks that the Fed's going to go pretty quick here. And in fact, we're still priced for basically a hike at every meeting this year, and maybe, a chance of a 50 basis point here at some point. I don't think that they'll be able to go quite that fast because of some of the risks that you mentioned to the growth outlook. But for sure, the market thinks that the Fed's going to hike and hike pretty aggressively.
Romain, let's bring you into the conversation here because we have to talk about the geopolitical tensions at play. It wasn't too long ago where we saw the Fed, the hawkish Fed, kind of take a back seat for yields, and now that's kind of driving the narrative. What do you make of it?
Well, it took a backseat briefly here. We talk about where we were sort of in mid-February, where you saw yields basically peak out at least on the 10-year, above that 207 level. They dropped immediately after that because of the war in Ukraine, because everyone thought the geopolitics would sort of overwhelm inflation. Well, the problem now is that geopolitics are inflation. And of course, the war in Ukraine has proven that inflation is not only a problem, but probably a bigger problem than what it was before the war. And that's a big part of the reason why you're looking at yields right now, making these moves higher. It's a big part of the reason, Kriti, why you're looking at break-evens. The expectations 10 years out above 3%. The expectations 5 years out right now at 3.6%.
Romain, what are stocks pricing? What is the stock market telling us? Is the stock market just a derivative of the bond market right now? Or is the stock market got any useful kind of signaling here? Stocks have remained relatively elevated through this. We've come down quite a long way, but you look at where we are in historical terms, we haven't come down that far. So just give me a sense of what you think the signal we're getting from stocks is. Are we going to get a recession? Are we not going to get a recession? Are earnings going to hold up? Are earnings not going to hold up?
I think the general consensus based on the pricing is that earnings aren't going to hold up. It's now a question, Guy, of how severe it's going to be. You think back a couple of months ago here, there was a pretty strong negative correlation between the rise in yields and the drop that we saw in stock prices. That correlation is still there, though not necessarily as strong as it was a couple of months ago. So I think when you see what happens on Wednesday with the Fed announcement, it's really going to be about two things. Not just whether we get a rate hike, but whether they decide to be a little bit more aggressive, go with 50 basis points. That's being priced out right now. But whether they communicate that going forward that, yes, there is a real scenario that we could see 6, 7, 8 hikes this year, and of course, maybe a faster drawdown of that balance sheet.
Ira, hop back in here into the conversation. I'm curious what this means when we're looking at things in terms of the commodity shock, because it kind of seemed like for a second the geopolitical situation, like Romain said, was outweighing the hawkish Fed. Do we expect comments from Chairman Powell on simply what that commodity shock might look like and how long it might last?
Well, I don't think he'll necessarily say how long it'll last, right? He'll say that it's unclear, that whenever you have these types of risks, that they'll continue to monitor the situation. But I think the answer to the question that he is likely to get asked, like you just mentioned, is, that the Federal Reserve can only do so much. The Federal Reserve really controls the demand side of the balance sheet. So to Guy's point earlier when we were talking about what the Fed's going to do, the Fed basically can only drive us into a recession in order to get inflation lower because it can only stop demand. I was just looking this morning at the number of gallons of gasoline sold because of how high gasoline prices are at the pump, and those have come off very dramatically. In fact, they're right at the lowest level that they've been about the last 5 years. So these higher prices are already crimping demand, and that's creating a tax on the consumer, which is going to slow real GDP and real economic growth going forward. But until that starts to hit the job market, the Fed is going to feel it's okay to hike. Now, once the job market turns around, if you start to see job losses at some point and a slowing of wage growth, that's when the Fed has to be really cautious. And that's why I think like the Fed ultimately is going to go a lot slower than what the market's pricing for right now. Now, what that means, of course, is that maybe 2-year yields are getting to a point where they're not going to be able to go up as quickly as they had been. But I still think you're going to see a 2% 2-year yield at some point this year.
Romaine, I'm curious about the point that Ira just made here, the fact that the Fed can't tackle those commodity prices. They're not tackling the supply issues, they're tackling the demand, right? But I'm wondering if you kind of put the demand destruction that you're seeing from commodity flows on top of the Fed trying to kind of control demand,
right,
at what point does that become a double whammy? And at what point does that become even bigger odds for a recession?
Well, I think this is what the Fed has to address, and this is the conversation that's going to be had on Tuesday and Wednesday, is how do you sort of ease demand? You don't want to obviously destroy it. In the sense of what the Fed is trying to do. But how do you ease that in the face of, I guess, market forces that are already seem to be doing that right now? And to Ira's point, too, when we talk about kind of the feed through into the stock market here, you keep an eye on some of those discretionary names, and I think that's where you're going to start to see most of the pain. We've seen it there already. Remember, this isn't just about what you're paying at the gas pump. It's what you're paying at the grocery store. It's what you're paying to go out to eat. It's what you're paying when you go to the store to buy, new pants for your kids. These are really already being felt. You see it anecdotally, and it's eventually going to show up in the data.
Ira, we're going to get a dot plot. We're going to get an economic outlook from the Fed this week. How big an upgrade do you think we're going to see in terms of the rate picture from that dot plot? What is the Fed going to be signaling? And to come back to this point about the demand side of the economy, how high do rates have to go, do you think, before we start to see a meaningful impact on the economy? Where do you think that point is? Do we need to get into positive real rates? How high do nominal rates have to go before they start affecting the U.S. consumer, U.S. industry?
Well, I have to say a couple of things about that. There's a lot of pieces to that question, but I think that the big thing is we have to remember inflation on a year-on-year basis is going to be lower in 9 months than it has been the last couple of months, right? So just base effects alone are going to drive some of that. And certainly if oil prices even just stabilize right where they are now, you're going to have inflation that's going to be closer to 4%. Do we need to get real rates to positive in order to feel the economic impacts of that? The answer is no. I think that we're already starting to see the economic impact of that. Certainly if you get mortgage rates that go up another 25 to 50 basis points, you're really likely to see the housing market slow pretty substantially. I know there's some supply issues. There's not a lot of supply of houses on the market, but at the same time, if you wind up getting mortgage rates that get close to 5%, it's hard to see that not crimping demand for the housing market. So there's a lot of pieces to the puzzle. So the Fed, I think, is going to, what you're going to see in both the summary of economic projections and the dot plot is a wider dispersion of outcomes that members of the Fed think are going to happen. So you have people like President Wallard and Bullard say you're going to get significantly higher maybe interest rates in the out term, maybe even 3.5% in some cases, but then others that still think that the terminal rate's going to be somewhere in the low 2% area. So I think that dispersion is going to be what is going to be the story for the summary of economic projections and the dot plot this month.
Well, lots to digest. Bloomberg's Romaine Bostick and Ira Jersey of Bloomberg Intelligence. We thank you both so much for your time. Coming up, we'll get an investor's take on our question of the day. What is the bond market really pricing? G Squared Private Wealth CIO Victoria Green joins next. This is Bloomberg.
Big things are happening on Bloomberg in March. First, Bloomberg Triple Take, breaking down the day's biggest stories.
Today's Triple Take focused on the energy transition.
Then, the return of Bloomberg ETF IQ.
The last major holdouts of the ETF revolution.
And the debut of Bloomberg Crypto.
The CEO of Binance weighed in.
Finally, David Rubenstein brings you insights and advice from the world's greatest investors on a new season of Bloomberg Wealth. All this March, right here on Bloomberg.
Let's get back to our question of the day. What is the bond market really pricing in? Joining us now is Victoria Green, G Squared Private Wealth CIO. It's an independent boutique investment advisory firm focused on ultra high net worth individuals with over $500 million in AUM. Victoria, thank you so much for joining us. Let's put that question to you. What exactly is the bond market pricing in? There's certainly a lot to digest.
Yeah, right now with the curve flattening as extremely as it has, I think it's pricing in that, look, I think a recession's coming and you guys should be playing defense a little bit more than playing offense. You know, I'll freely admit we came into this year as a buyer of dips. But you can't be agnostic to this fundamental shift that's happened with the Russian war in Ukraine and the likelihood that sanctions are going to stick and inflation is going to be longer. We all thought inflation would peak here, Q1, Q2, and now that keeps pushing out inflation even further back. I mean, your break-evens now on the 10-year are above 3% for the first time ever since '98.
How do you position for a recession? Should you position for a recession? Should you position for a recession once it's arrived? I'm wondering what history tells us, Victoria, about what stock investors in particular should be doing as they think about the possibility of a recession coming. What is the right place to be? How do you sequence that story out?
Sure. So first off, there's a lot of variables on the table here. So our signals flashing that a recession is probably going to come, yes, but you haven't seen a lot of signals flip left yet. PMI still above 50, unemployment rates at 3.8. That's very low, but hasn't bottomed out yet. The curve is very close to inverting. I think the 5-10 spread's now like 5 basis points, but hasn't inverted yet. So you have all these signals on the precipice that could reverse, but right now we are thinking that this drag from the war, the inflationary drag that's going to come from economy is going to put pressure. So what do? I think you want to shore up your portfolios. I think you want to be in areas that are a little lower beta, a little higher quality. You want companies that have cash flow, that have strong balance sheets, you know, ability to weather a little bit of a tighter market and not be so stretched and probably not trading at that valuation.
Victoria, you got any names for me? You got any names for me?
Yeah, we like the energy space still. I mean, I know they've been on a great run, but we think energy prices will remain high. You know, we like on the big side, the Chevrons are a good place to be. We like the EMPs, your Devon Energy. Honestly, a name that not a lot of people talk about is we like IBM. That's a great value tech stock. It doesn't mean you have to shun tech from your portfolio, but you want to be buying things that have, like I said, stability, quality, not trading at an extreme multiple, and generally looking around. Now, financials have come off a lot. I think you want to own the right financials right now. We're bunkered a lot more in the U.S., so we're looking at names that have a little less international exposure, a little more U.S. domestic exposure for their revenues.
Victoria, we're seeing a little bit of green on the screen when we're talking about the equity market here. Is the bottom in from simply the sell-off that we've seen that really hasn't let up since the start of the year? What do you think?
I mean, I'm just happy to see green, but I'm going to say let's see if the green holds through close. That's always been killer for us, right? Holding on to our gains through end of close. I don't think the bottom's coming in until we have a clear resolution of what's happening in Ukraine. And even our best case scenario that we get to the negotiating table and the conflict stops, looks like we're probably going to keep sanctions on Russia, which is just going to make the inflation story even more difficult. I don't think the bottom's in yet. I think if you have a strong stomach, you know, and we have any more extreme dips, you might look to add to it, but I don't think this is over yet.
Victoria, when we get a recession, if we get a recession, what does the Fed do at that point? Because, yeah, let's say we get one. What does the Fed do? Does the Fed want to lean in and make that recession easier, i.e. reduce rates, maybe do other things in terms of the policy tools that it has? Or is it going to look at that recession and say, this is what is required? We need to deal with the demand side in order to deal with the inflation, as a result of which you're not going to get a quick response from the Fed when that recession comes?
Yeah, I think the Fed wants a time machine. I think the Fed wants to go back and start hiking last year. I think the Fed's in a horrible spot. They've got to go. Inflation's rampant. Inflation's going to stick. I'm still on the 6 hikes. I don't think the Fed is going to be dovish. I think they're going to run off their balance sheet. I think they feel like they have to. I think they know they're playing from behind at this point. So I think the people expecting the Fed to kind of run in and that, oh, if we start slowing down, will the Fed slow down? I feel like the Fed feels like they almost have to move enough to give them that cushion that they can come back down on rates when we hit an actual recession. And remember, GDP is like 2/3 of the consumer. And so if this consumer is getting squeezed at the pump, the consumer is certainly going to have less to spend elsewhere, and they're getting squeezed at the pump, the grocery store, as your other guest had mentioned. So Fed, I don't think, has any choice but to be hawkish, and it's an unenviable position to be in.
So, Victoria, we've talked about the Fed. We've talked about Russia and Ukraine. The other major story this morning has simply been China's zero COVID policy, the fact that they've shut down their major technology hub. How much of there is a read-through into the United States, into the West, from what's going on in China?
It's going to bleed. I mean, as they shut down chip factories, I think Foxconn shut down, and you're seeing that drag a little bit on Apple. And they certainly do supply a lot of things for us. So we have to be cautious of what a shutdown will do. I think the zero COVID policy is a smaller minority of the world. I think the rest of us have kind of decided to live with it as our policy. So I don't see lockdowns continuing to spread anywhere, but I do see that just making the supply chain even worse. You know, you just seem to have this confluence of factors and, you know, between Russia getting frozen out of the market and now China's kind of self-freezing them out of the market, and then concerns if China will get sanctioned if it sides with Russia, you're talking about just making it harder to get parts.
Victoria, is all of this manageable? Or is there a danger that some of this becomes systemic? Some of the problems we're experiencing right now, it could be a Russian default, it could be China having problems with its property sector. There's a whole range of potential things that could be systemic here. Do you think we could be heading towards a systemic event? And again, is that something that's just a tail risk right now, or is that creeping in from the tails?
Look, I'm never a big fan of like the sky is falling and everything's going to be terrible. I think the higher probability is these do work out without the end of the world per se economically. You know, there's different types of recessions, either the duration or the severity of it. I don't think this is an 2008 type global meltdown, but you do need to see some cooler heads prevail. We'd like to see some progress. I think all of these problems could be fixable. So I don't think it's good for the world at all. I mean, it's sad for me. I don't like being bearish. It's just, it feels wrong to bet against the world, and that's what it feels like when you say, hey, look, there's risk in the market. But I think investors can bunker in. I don't think all stocks are created equal. We've seen that, the growth value divide here. I don't think this means you just need to sit in cash, because there's a risk to cash in an inflationary environment.
Absolutely. Inflation. Victoria, great stuff. Thank you very much indeed. Victoria Green of G Squared Private Wealth. Thank you very much indeed. What have we got coming up for you? The US is seeking China's help to end the war with Ukraine. We're going to have the latest on the high-level talks. They're happening in Rome right now. We're expecting a briefing shortly. This is Bloomberg.
Web. This is Bloomberg.
So the US and China holding their first high-level in-person talks since Russia invaded Ukraine. The Biden administration wants China to exert its influence over Moscow to end this war. Jake Sullivan might be briefing shortly. We should get a readout fairly soon. What should we expect from this conversation, though? Let's go to Washington, D.C. to find out. Bloomberg's Washington correspondent, Anne-Marie Hordern, joining us now. Anne-Marie, what does the U.S. want out of these talks? Does it just want China not to help Russia, or does it want China to actively talk Russia down, i.e. find a way out of this?
Well, I think it would be the latter, Guy, but I think they're willing to take what they can get in this moment. At the moment, China has tried to remain somewhat neutral. They haven't come out and condemned what Russia is doing outright, but at the same time, they've also have called for peace, and they've held calls with Ukraine as well. I think a lot of focus will be on if there's any potential of China giving military assistance. From the reporting over the weekend, U.S. officials saying that that is an ask that Putin has made to Beijing, but so far there's been no reporting or intel that China is actually following up on that. So I think this meeting comes at a critical time for the U.S. to be frank with Beijing on what they would expect, and for them would be putting the pressure on Putin to make sure that he knows that he would be crossing that line with really what is his only closest ally right now if he were to continue with this war.
And Marie, talk to us a little bit about how you square the United States' own tensions with China. We're talking about tariffs, a trade war that's kind of ongoing in the background with their relationship with Russia in particular. How do those two conflicts kind of work together or work against each other?
Well, I think at this moment it might actually help the United States, not the fact that they've had this trade conflict over the past few years and that's likely going to continue. But when you look at trade, even though Russia and China, their trade between the two countries have reached new heights since 2015. When you look at military arms going from Russia to China, even though China has some better technology, that dwarfs what China has in trade between the European Union and the United States. And this is really telling what Secretary Raimondo said last week, really putting chip makers on guard about usurping and going around U.S. sanctions to make sure these Chinese companies know that they need to come in line with the sanctions regimes and they can't be seen helping President Putin.
A headline coming through on the story that we're covering: Russia may halt wheat, corn, rye, barley exports on March the 15th. This according to Interfax. We'll try and get some details on what exactly is happening here, but that would have serious implications and ramifications, certainly in North Africa and Egypt, in places like that, Anne-Marie. So the cost of this is going to spread out and continue to be a global phenomenon. Which brings me to my kind of last question here. The Chinese, as you say, are heavily interlinked into the global economy. If they provide a route for Russia to find its way back into the global economy, there's a risk of secondary sanctions here. How clear is the U.S. going to be to China that it doesn't want to go down that road?
Well, I think Jake Sullivan over the weekend, the president's national security advisor, signaled that there have been these very direct conversations in private. And now just the fact that he is going to Rome, meeting with the top Chinese diplomat, I think proves that these conversations are going to be pretty direct face to face. I imagine that is what they are going to say to his Chinese counterpart.
Well, Bloomberg's Anne-Marie Hordern, our Washington correspondent, we thank you so much for your time. Coming up, China orders a lockdown to one of the country's big tech centers. Companies like Apple will feel the pinch. We'll look at what this means for the country's growth prospects next. This is Bloomberg. We're an hour into the U.S. trading session. A little bit of green on the screen. Bloomberg's Abigail Doolittle is tracking the moves. Abby, what are you watching?
Well, Creedy, we do have some green on the screen for stocks. We at this point have stocks higher. In the pre-market, sharply higher. The S&P 500 and the NASDAQ up more than 1%, then a little bit of a dip. Right now, that S&P 500 up 0.6%. This as oil falls. WTI crude is down about 7% and at close to $100 a barrel. Not there yet, but we could see that move lower as we've been talking about over the last week. That typically when you see a huge surge up, it often is unsustainable and will reverse to some degree. As for what else is moving in the market and what has been going on over the last 6 days really under the radar, this massive backup in yield. We have been talking about it here, but relative to oil, commodities, stocks, and everything else going on, this 37 basis point 6-day backup in the 10-year yield is really just incredible. This, of course, into the Fed meeting, the decision on Wednesday at 2.1%, the highest since I'm actually not sure what level, but probably 2019, I'm guessing. So you have this huge backup that suggests that the Fed is likely to do that one hike, maybe more, based on this huge move. But also another big story, the China tech plunge. We've been following that over the last couple of days, now down 3 days in a row. The Golden Dragon China Index down off of its lows, but nonetheless, last week, the worst week ever going back. Actually, the worst week since 2008. The last 3 days, the worst 3 days since ever. And you can see JD.com and Alibaba more pain. The question is, will this China tech pain bleed into the rest of the markets? Up top, we're looking at the Stock 600 Tech Index along with the NASDAQ 100. In yellow, we're looking at that Golden Dragon Index, and you can see it's an absolute plunge from its peak in February. All of that having to do a lot with Alibaba and the Beijing crackdown on tech, down 74%. If that's not a bear market, I don't know what is. But again, there's this huge divide, Guy, between the NASDAQ 100 and along with the Stock 600 Tech Index. Are we going to see a similar move? Hopefully not, but who knows?
Yep, Panda Bear. Abigail, thank you very much indeed. Abigail, on what's happening in these markets right now. That story relating to what is happening in China, what is happening with COVID, seems to be kind of re-emerging onto the agenda right now. It's interesting, actually, compare and contrast. JP Morgan, masking in corporate offices to be voluntary now for all. JP Morgan to end mandatory testing for unvaccinated staff. JP Morgan comments to staff in a memo on office measures. This is now being circulated. JP Morgan to resume hiring unvaccinated individuals from April the 4th. Here in the UK, the rules have largely gone. In the United States, they're fading fairly fast. But in China, the zero COVID policy is still in force, and it's having a meaningful impact. China taking now some tough steps to deal with a doubling of coronavirus cases nationwide. It's now locking down the city of Shenzhen and forbidding people from leaving a province in the northeast part of the country, just north of North Korea. Sam Fazeli of Bloomberg Intelligence joins us now. Sam, what is the long-term trajectory here? It is clear that the vaccines in China aren't as effective. It is clear that they haven't broken the back of the virus. It is clear that this zero COVID policy is going to have large economic impacts for quite some time. What do you see China doing next? Is there a way out from this?
Hi, Guy. I honestly don't see an easy way out of this. So let's say there's two things they can do. They can let it rip, which is obviously not what their intention is at the minute. And then, of course, that has people sick, people off work, and enormous costs in terms of health and impact on people, deaths, etc. The vaccines do have some effectiveness, but they're just not as good as what we've seen with Pfizer-BioNTech and Moderna shots and the adenoviral shots. So that's one way, which I don't think they're going to do. The other one is just keep doing it this way, which of course will have a similar impact in that shut down cities, shut down ports, still don't function. And I just don't see how they can get out of this without resorting to some massive wave of vaccinations again and then letting it rip, a little bit like New Zealand.
Sam, let's talk a little bit about your latter point here, the idea that perhaps there needs to be another wave of vaccinations to make this zero COVID policy just a little bit more functional. Do you see the likelihood of perhaps that fourth booster shot in China or even here in the United States? What does that look like?
Yeah, I think we should leave the West out of this conversation because the fourth shot, I'm not convinced yet that there's really much need for it unless you're obviously having immunosuppressed situation or really elderly, etc. There's no data that suggests to me yet that we need to go there. Especially that the effect is short-lived. Israel has already shown us that. In China, what I think they need to do is not just any fourth shot. I think the data that I've seen so far, Mexico had some good data, some of the other South American countries have some good data. If you combine a mRNA shot, for example, from Pfizer or Moderna, on top of what China's already used, you get a really good effect. That's going to be interesting because they haven't approved any of those vaccines.
Well, Sam Fazeli,
production possible, Sam? Is that something that we have the scale of production to be able to do? How quickly could China, if it was given the technology or be able to license it, be able to ramp it up to that kind of level?
But Guy, and I'll be very quick here. China already has a regulatory filing for the BioNTech shot in their hands since summer last year. They can approve it, probably 100 million doses. The US has surplus doses. They could agree in a deal, I don't know how feasible that is or whether they want to do that, to donate those shots or sell them to them. I think the government can do that. So you could get a few 100 million shots relatively easily.
Well, Sam Fazeli of Bloomberg Intelligence, we thank you so much of your time. How big of an impact will this have on China's economy, though? Let's bring in Tom Orlik, Chief Economist for Bloomberg Economics. Tom, wonderful to have you. Let's talk a little bit about that impact. What is the read-through of these kind of port shutdowns, of these city shutdowns into essentially China's bottom line?
So I think there's three things going on here that we need to think about. So the first is the immediate negative impact of the fresh lockdowns that we've seen. Shenzhen is not a small part of China's economy. A major industrial center, tech center, port, huge population. Shutting down Shenzhen is not zero cost. The second piece of it is the big question, what happens next? In 2020, the shutdown of Wuhan was a prefiguring of the shutdown of the entire Chinese economy. Is that going to happen this time? Don't have any good information on it, but you don't shut down Shenzhen for nothing. If we have broader shutdowns, clearly that's an additional drag on China's growth with ripples for the rest of the world. The third big question, which again is in the world of speculation, but what's the interaction here with Russia and Ukraine and US sanctions? One of the big stories over the weekend was the idea that Russia has been asking China for military help. China has denied that. We'll see how that story plays out. But potentially, in a nightmare worst case scenario, we could have a situation where COVID fears are back for China and China is somehow dragged into the US, Ukraine, Russia situation with implications for sanctions and for China's exports and their access to technology.
What kind of sanctions would you expect? Would it be financial sanctions? Would it be the financial sector that was to be sanctioned? Do we have any model, Tom, for how this could be applied? What are the most effective tools to be used against China were sanctions to be necessary?
So I think we're still in the world of breaking news and speculation on this one, Guy, so I'm kind of reluctant to go into too much detail. But if you think about what's happened to China in the last few years, with sanctions on technology, with tariffs on exports, with the beginnings of financial decoupling, delisting of Chinese firms in the United States, for example, I think there are clearly some areas where if these stories turn out to be true and China is dragged into the Russia, Ukraine, US situation, then there are some avenues where existing controls could be expanded and hardened.
Tom, I'm curious about the read-through into the United States. I think one of the main stories that has come about on the back of this essentially shutdown has been Foxconn and the impact on Apple's kind of supply chain. What is the read-through into American companies, corporate America?
Well, China is the second biggest economy in the world. So bad news for China is now bad news for the rest of the world. And you hit on one of the dynamics. China is a center for production and a driver of demand for some of the biggest US companies, from Apple to Nike to McDonald's. But the consequences go further than that. The world continues to struggle with supply chain snarl-ups. Well, guess what? Shenzhen, one of the world's busiest ports, one of the world's busiest tech and industrial centers, has just locked down. Clearly that is not good news for supply chains, and that has implications for the inflation outlook as well.
Tom, always smart analysis. Really appreciate your time. Thank you very much indeed. Tom Orlik of Bloomberg Economics on what is happening in China and potentially the implications for China were it to be dragged in to the Ukrainian conflict. Coming up, the war has already had an impact on supply chains. We've already started to see that coming through. We've now got this Chinese factor to think about in terms of Shenzhen. We're going to talk all about this next with the CEO of FreightWaves, Craig Fuller. Great analysis. You want to listen to this. It's up next. This is Bloomberg.
Find answers now.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. The British government is set to offer a new system for admitting refugees fleeing the war in Ukraine after several weeks of criticism. The new system includes payments to households accepting refugees. Cabinet member Michael Gove told the BBC he expects tens of thousands of Ukrainians will eventually be admitted. North Korea may test an ICBM as soon as this week. That's according to South Korea's Yonhap news agency. A report says South Korea and the US have detected signs of an imminent test of an intercontinental ballistic missile. North Korea hasn't test launched an ICBM since 2017. And in sports, pro football star Tom Brady changed his mind and is not retiring after all. Brady said he will return for a 23rd season in the National Football League. The Tampa Bay quarterback says he's realized his place is still on the field and not in the stands. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Guy.
Thank you very much indeed, Ritika. The number of container ships waiting off one of China's biggest ports is rising as the country doubles down on its COVID-0 policy. The latest lockdown in Shenzhen adds more delays to the strained global supply chain. Shenzhen is the fourth largest port in the world. Just to give you a little bit of context here, this is a massive blow to the freight market. Joining us now to discuss this is the founder and CEO of FreightWaves, which analyzes the data for this industry, Craig Fuller. Craig, Shenzhen shutting down. This is a massive port, fourth largest in the world. How are you reading the implications?
Yeah, there's a lot of uncertainty. This is something that we thought we were largely done with or that was behind us, is the COVID impact. But China's zero tolerance policy has reminded us that supply chains are still subject to massive disruptions, and the COVID element in supply chains is still ever present. If we remember back in the United States when Omicron hit, we really just sort of treated it as an unresolvable and sort of gave up on trying to contain it and just went about our lives. China doesn't seem to operate that way or want to operate that way, and because of it, I think we'll see a large disruption to global supply chains. This is expected to spread, or would expect it to spread if we've seen it, the precedent that was set in the West. And if it does, and China decides to continue their zero tolerance policy, it could have massive implications, very similar to what we saw in early 2020.
Craig, can you talk us through the timeline here? If you do start to see the shutdown now in the ports, when does it kind of come back? When do you see the read-through into the rest of the world? And where does that translate into things like shipping rates or trucking rates?
Yeah, it takes about 6 to 8 weeks for when you see a shutdown for it to impact the Western economies, just because it takes a while for that freight to ship. The good news for the American freight market, at least short term, is that there is a lot of still bottlenecks and at the ports. There's a lot of containers that are still available. So we have some short term demand that will keep the freight market moving. But if this goes on for months, or continues to be disrupted and we have fits and starts, it could have profound impact. As you mentioned, freight rates, particularly those out of China, it actually depressed those rates if we start seeing ships not hauling cargo, but actually sitting at ports. We'll see freight rates drop because there won't be any demand. And so we'll see the alternative short-term really drop, but long-term, we'll also see a surge because a lot of those products there'll be a substantial backlog. So I think it all depends on how long and how pervasive this is throughout the economy, really will tell us whether this is a repeat of 2020 or a short-term blip.
Craig, as we speak, WTI crude, the US benchmark falling below $100 a barrel. That's a $35 swing this month. How is that kind of volatility impacting the freight industry? Diesel, certainly a major factor here in Europe right now. What are you seeing? How much of this is kind of easy to pass on? Do the models cope with this kind of volatility? What impact is fuel having?
Well, the good news for the larger trucking companies, which have not had a lot of relief lately, just because of the driver shortage and the lack of being able to fulfill drivers, is that they'll be able to pass these costs on to shippers, people that buy capacity. So 75 to 80% of the capacity in the United States is fixed under contracts, and those contracts enjoy fuel surcharges. So a lot of those cost increases will be passed on to shippers and then ultimately consumers. As it relates to the spot market, that's where the squeeze is. When you see this really high, rapid increase in fuel prices, is it squeezes out the owner-operators, which operate in the spot market. And they did see a tremendous impact last week and over the last 2 weeks. And so short-term relief will be positive for the trucking industry, but we are seeing signs of a slowdown in freight demand. It's really, in many ways, caught us off guard because you normally expect the shipping season to pick up in March. March is one of the best months in freight, particularly in the domestic surface market, and that has not shown up this year. And so it's hard to understand what is causing that. But we are seeing a slowdown in freight, and therefore spot rates for those owner-operators, they're not able to pass on those fuel surcharges to shippers because they're simply just chasing the rate down.
Craig, a lot of what's driven some of that commodity volatility you were just talking about has been, of course, those geopolitical tensions with Russia, the Russian invasion of Ukraine. Can you speak to a little bit about what that means for the shipping market in particular, specifically around the Black Sea area?
Well, I think when you have disruptions and you see a lot of the agricultural commodities and other commodities, energy related, and just any of the mining commodities that come out of Ukraine and Russia, that has a tremendous impact on the global economy. But I think a lot of that is really European related. We do see high increases in rates for these products, and commodity prices really accelerate, which impacts everybody. The good news for North America is that we're a net exporter of the items that are seeing these rapid increases, whether it's agriculture or a lot of energy commodities. Yeah. We are a large producer of those. So in some ways that benefits particularly the freight market, because a lot of the industrial activity in the United States is tied to those commodities. So whether we're talking food or whether we're talking energy or energy related, a lot of our industrial economy is actually benefits when you see high demand. So in some ways, but Craig, at least long term, it could have a net increase in demand and in manufacturing in the United States, and that is a positive development. But certainly that will have a tremendous impact on prices. It could create an acceleration of inflation. All of that has a negative impact on global markets.
Craig, if we don't see wheat, corn, rye, etc., being shipped out of Russia or Ukraine, it has to come, I'm assuming, to the markets that it currently serves from further away. Is there the seaborne capacity to do that? Is there the capability to pivot and bring in crops from elsewhere? Does the global sort of food supply chain, how much flexibility does it have built into it right now?
Well, the good news is, particularly we're looking at Europe being the most impacted, is there is an imbalance. There's more freight coming into the United States from Europe than there is going the other way. So that trade lane actually has a lot of available capacity. And so the ships that are able to transport grains from the United States into Europe actually have available capacity, and therefore I don't think it will be a capacity issue as it relates to freight out of the United States into Europe. So generally that's a positive, and it's true as well for Canada. And so North American, being a supplier of these grains, will actually be able to supply Europe with a dependable amount of supply, and shipping will not be a factor in disrupting that. All of this, of course, depends on how long this goes on and whether we see continuous outbreaks or an acceleration in geopolitical tension that impacts all of it. But generally, I think the U.S. and the Canadian agricultural markets, and really throughout the Americas, can handle it. And because they tend to be, particularly out of the U.S., tends to receive more freight from Europe than it sends out, it actually could in some ways balance those lanes.
Well, Craig Fuller, it is fascinating to talk about this. FreightWaves founder and CEO. Guy, I'm very curious about how this all plays out, because it's crazy to think that there are going to be these kind of decline when you talk about commodities, yet you heard what Craig said. There's simply the shipping market isn't quite digesting it in the way we would think they would.
So I think the story around food is going to be the one that we're going to spend actually most of this year talking about, particularly here in Europe. I think if you are going to see a failed crop effectively in Ukraine, and then you're going to see Russia not shipping grains around the world, particularly into kind of key North African markets and areas like that, that is going to be a hugely inflationary and potentially societal impact. So I think we don't fully yet understand the implications of it. I hear what Craig's saying about the fact that there is capacity to ship out of Canada, etc., and the North America more broadly. But nevertheless, this is going to be inflationary, and we saw what happened last time. We saw ag prices going up as much as this. We got the Arab Spring. The impact geopolitically, I don't think we fully felt it yet. Anyway, it's going to be something that we're going to spend a lot of time talking about. This is Bloomberg.